So welcome back, everybody, for another webinar organized by Princeton for everyone worldwide. We're very happy to have Yuriy Gorodnichenko with us. Hi, Yuriy.
Hello.
Yuriy is from UC Berkeley, and he's originally from Ukraine, and his heart and mind is probably now in Ukraine. We're very grateful that he's with us and talk with us about inflation expectations. And hopefully we can also touch a little bit on the current circumstances during our webinar here. So I will give some few opening remarks on inflation expectations. I would like to focus very much on the inflation anchor. The inflation anchor is, of course, a forward-looking concept, depends very much on inflation expectations. And the question is, how long are inflation expectations anchored? And that depends, the anchor holds as long as people think when inflation goes up, it's only a temporary phenomenon and will return back to the normal level. And if you have a strong anchor, then actually you can smooth out shocks. Monetary policy can smooth out shocks, and that bounces back. So you have a lot of resilience in the system. Monetary policy can make the economy more resilient. But if you overstretch it and the anchor breaks, then actually the resilience also breaks, and then you have amplification going on. And that's why, having a strong anchor is very, very important. And re-anchoring once an anchor breaks is very, very important, is very costly, because you have to build up trust and reputation. Once you've lost the trust and reputation, actually, it's very costly to generate this again. But the question is, what actually stabilizes an inflation anchor? What constitutes an anchor? And you might say, what's an anchor? An anchor essentially is actually some coordination of beliefs that we all think that this is actually, we stick with 2% inflation. In the long run, we come back to 2% inflation. So it's a convention, and has to be common knowledge among the people or most actors in the economy. So it's all about higher order beliefs that we also believe, that the others believe, that we will come back to this. And once you have disagreement about this, or uncertainty, this higher order beliefs are much more harder, much more difficult to coordinate. So it's harder to coordinate. So the question is it more disagreements which matter, or is it more the uncertainty? And that's a picture I've shown also last week, where you see the mean expectations of inflation is going up significantly, but also the disagreement, the most optimistic guy with the lowest expectations, and the most pessimistic guy with the highest inflation expectations, that's widening too. On top of what's between the two dashed lines, that's the range, how much uncertainty there is in terms of inflation expectations. So this is data from the New York Fed, which collects these data from households. Now, how can you strengthen an inflation anchor? And then what helps is to have a strong focal point. It's 2% or strong focal point helps. And as I pointed out, so these slides are based on my presentation at the Jackson Hole meetings in 2021. It also helps not to have another focal point. So if there's a focal point at 2%, but there's another focal point at 3%, then it's actually easy to jump from 2 to 3%. So this creates, an easier jump. But if there's confusion what the other alternatives would be, and there's a lot of disagreement about alternative focal points, it actually stabilizes the current focal point. So the anchor will be stronger. So one has to be very careful not to say, there might be another focal point. So focal points are really crucial in order to understand inflation anchors. Now, and of course, as the trust in the central bank, or the reputation of the central bank, makes a huge difference. So if, the inflation spikes because of some policy mistake, that's much more concerning than if inflation spikes because of some exogenous shock, some geopolitical tensions, as we're experiencing now, energy prices are going up. That might actually not ruin the inflation anchor as much as if it's seen as a policy mistake. So we have the current circumstances where energy prices will go up even further, given the situation we see in Ukraine. That might be seen as an exogenous shock, and actually might not destabilize the inflation anchor as much as a policy mistake would be seen this way. Of course, we have also seen a new policy regime being established in August 2020, monetary policy regime. And as long as the policy regime is very imprecise, when you do average inflation targeting, you don't know how many months to do average inflation targeting. It also makes it harder to have a clear inflation anchor. Now, the other thing is, going back to inflation expectations more generally, what I find very fascinating is this concept of salience, and I think Yuriy will tell us a lot about this. What, for citizens, how do they form inflation expectations? If you take a new Keynesian perspective, it's all about staggered price adjustments, and I don't know when the others, they will only adjust later, hence I will not adjust the prices right away as well. So it's all about the strategic complementarities across various firms or across various players in the economy that slows the whole adjustment down, and that also, knowing that they can't adjust it, it also affects my expectations about the future. But if I take a more behavioral perspective, it's the salience of certain prices, and I don't know where this is coming from. Certain milk, price of milk, or gasoline price. In Germany, it's actually chocolate, which matters a lot. I don't know why, and there's some, the field inflation, what people perceive as inflation, is very different often what the real inflation is. And the question is, why does energy prices, why do they carry so much weight? What's the geopolitical situation again? And why are certain prices so much more flexible than others? So with this opening remarks, I'm just raising a lot of questions, and hopefully Yuriy will reply and answer them all. And here are the questions actually Yuriy put in the poll questions. And he asked, what source do you use for your own inflation expectations? Is it the media, professional forecasters, the government, or your personal shopping experience? And actually, for this audience, we have, that's probably not representative for the whole audience in the world. The media is about 25%, a quarter. The majority say professional forecasters, 40% almost rely on professional forecasters, government 18%, and the personal shopping experience 17%. So I'm not sure, our audience are mostly economists, so it might be quite different from what we normally conduct a survey for the general public. But Yuriy will tell us about it. The second question is, what's your guess about the annual inflation target for the Fed that tries to achieve on average in the very long run? And you're 85%, 2%. So 85, huge majority think 2% inflation target, that's what we'll achieve. And then there's few, 13% I think is 3%, and then 2% think the Fed tries to achieve 5% on average inflation. But the anchor seems to be still holding, at least among professional economists. And what is the price of gas per gallon today? That's the question. Then people answered the following: 253, that's about 5% said. 353, it's about 47% said it. And $4.23, 33%, and $4.53 is 16 cents. Of course, it depends which part of the country in the United States you are, because gasoline prices vary a lot. But the majority was in the middle range between 353 and 423. And that's what we think. So let's see what Yuriy will tell us. He will solve all the puzzles and probably put it all in a bigger context compared to what I raised here. So again, thanks a lot for Yuriy for doing this, especially in these difficult times. We're very grateful for that. Thanks. The floor is yours.
Thank you, Markus. Well, while I'm trying to share my screen, I wanted to say this. First of all, thank you for inviting me. It also gives me an opportunity to take my mind away from what happens in Ukraine and do something useful. I will also say that this audience is very different from what we have in the field. So again, thank you. I'm from UC Berkeley and Ukraine, and I will try to answer some questions that Markus raised in his opening remarks. Thank you for this very interesting questions. I also realize that this audience is very different from what you typically see among households and firm managers. And this is a great question. What inflation expectations are? They're obviously very important, and there is a lot of discussion about that. We see inflation being very high by historical standards. We also see that inflation expectations are very, very high by historical standards. And so we have lots and lots of questions about, what drives what? Is it inflation expectations driving inflation, or maybe the other way around? People are just reactive to what happens. in the real world, and that's why they increase their inflation expectations. I'm very glad I had great speakers just before me, Ricardo and Alan. They talked about how we should think about the distribution of expectations as a new rise of inflation on the horizon. Are we going to have a repeat of the 1970s? What policymakers should do about this? Should we aggressively raise interest rates to fight inflation and have some risk of a recession as a result of that? Or maybe we should look for a soft landing. So this stuff is extremely policy relevant, right? And we really need to understand how inflation expectations are formed, and what is the key driving force behind inflation we have today. Now, I want to say this is not just about today. We know that inflation expectations show up in almost every dynamic macro equation we have out there. It shows up in the Phillips curve, in consumption equation, in our investment decisions, in the central banking decisions. But one thing I want to stress here is that when you look at the prices and wages, that's not expectations of professional forecasters or people like you and me. It's really expectations of CEOs and managers. For consumption decisions, here inflation, that's not inflation expectations of professional forecasters or the Fed or financial markets. It's really expectations of households. And so one thing I want to emphasize here from the get-go is that we have different expectations out there in the economy, and we should appreciate this heterogeneity and the importance of this heterogeneity for policymaking and for macroeconomic dynamics. Now, so I hope I convinced you, probably don't need much convincing, that inflation expectations are very important. And to give you a summary of the state of knowledge we have about inflation expectations, I'll give you 3 quotes from prominent central bankers. The first one is from Alan Greenspan many years ago, when during an FOMC meeting, he was talking about the risk of inflation. And he said, look, inflation expectations are clearly very important. I don't know what it is exactly, but I know it is important. We need to figure this out. Some years later, Ben Bernanke gives another major speech, and he says, look, I know inflation expectations are very important, especially for price setters. And unfortunately, for price setters, we have very little information, but we really need to do more research here and better understand inflation expectations. Janet Yellen, some years later, another major speech about the importance of inflation expectations. She says, we really need to understand inflation expectations, and we really want to use them for policy. If you hear recent speeches by Jay Powell, he's making similar remarks. Inflation expectations are terribly important. We're watching them. It's something which is providing us with a key ingredient in policy making. I always talk about how anchored or unanchored inflation expectations are, and Markus mentioned this in his opening remarks. But when you read these quotes and kind of look at current discussions, you wonder how much we have learned about inflation expectations, right? So for 30 years, there is this perennial question what inflation expectations are, and it seems like we know very little. But this would be an unfair description, because since the great inflation in the 70s and 80s, we actually did a lot of research. We have much better data, we have much better models, we have much better understanding of what inflation expectations are and how we can use them for policy, and the importance of expectations for inflation and more generally for other macroeconomic variables, how important they are for understanding macroeconomic dynamics. Now, to give you kind of a brief overview of what we have learned over this many years, is that we started with non-rational expectations. The idea was that there is some psychology out there. People are not particularly sophisticated. They use backward-looking expectations, so we basically treat these expectations as something exogenous. That framework failed miserably during the 1970s, when it became clear that inflation expectations are moving, and the people are not stupid, right? They're actually very sophisticated. And maybe we went too far in another direction. We said, well, now we will assume that people have full information rational expectations. That is, people know everything about the structure of the economy. They know the shocks hitting the economy. They can quickly calculate optimal response functions, not just for themselves, but also for everybody else. And Markus was mentioning higher order expectations, which means people can iterate forward or up, I don't know how to describe this, to figure out what is the best response for them. And it's an extremely useful framework because you can be right in this framework in only one way, but in some respects, as I will argue, this is not a very satisfactory framework for explaining micro-level data. Now, so ever since, people have been trying to find sort of a compromise, a middle ground between these two extremes, where on one hand you have people being too stupid, and on the other hand people being too smart. And the two basic strategies are either assume that there is an important behavioral element, that there is some cognitive limitation, there is some behavioral bias or behavioral constraint, or there is some explicit cost of collecting and processing information. And this is why sometimes people choose not to know everything. And as a result, their inflation expectations can deviate from what is predicted from full information rational expectations. So there is a lot of research, and as I said, this is a very active research area, and so that's why probably what I'm going to say is still going to be tentative and preliminary. But what is coming out from a lot of data work and theoretical work is that we see that FIRE is probably full information rational expectations, is probably a good description of how people think about inflation in the longer run. So people eventually figure out the rate of inflation, they figure out nominal and real shocks. But in the short run, in the medium run, we see massive departures from full information rational expectations. So if you ask people about what inflation you expect, many people will say 10%, and we didn't have 10% in many, many years. Some people will say 20%. Many years.
There was a famous Fed paper came out recently. It's probably not representing the whole of Fed, but arguing that expectations are overblown and they're not really so important. Can you have a quick reaction to that paper too? Or?
Yes. So I will say more towards the end about this, about the which paper. Yes. But in a nutshell, it's one of those challenges and expectations that it's clearly an endogenous variable. And so there's causal statements about, okay, we have a change in expectations coming from somewhere, from an exogenous source of variation, and this translates into actions. This is a huge challenge, but again, we have some success in recent research suggesting that you can run like randomized controlled trials or focus on natural experiments, and then you can have more clear, more conclusive evidence on the importance of inflation expectations. This literature is full of challenges, and one of them, obviously, how you measure expectations. You have to ask people, what do you think is going to happen? And there was a lot of resistance in macro to this kind of approach. For example, Ed Prescott famously said, we shouldn't ask people about expectations because you'll get nothing. It's like utility, it doesn't mean anything. And his suggestion was that instead of asking people to report their beliefs, we just look at their actions. And then once we have a model, we can filter this stuff through the model, and we will have model consistent expectations. So we don't need an independent measurement of expectations. Now, this is an extreme version, and there is a lot of follow-up research and response to this line of reasoning, saying that expectations may be actually useful. What people say is not just cheap talk; they act on these expectations, and we know that, for example, these variables, at least at the minimum, are helpful in forecasting the actual dynamic of inflation. So it's not just noise. Now, so if we take this, point aside and say, okay, we believe that we can measure expectations with survey, then the question is which expectations we should use. And I told you in the beginning that we have inflation expectations showing up in many, many places in our macro models. In the pricing equation, good pricing equation, that should be expectations of managers. Then you have asset pricing, this is financial markets. You also have professional forecasters. I'm very glad this audience is so reliant on professional forecasters because that's not what most people do. And you know, when you look at the data, the differences between all these different agents is striking. For example, here the blue line is inflation expectations of households in the U.S. from the Michigan Survey of Consumers. The red is asset prices, the green is professional forecasters, and the black, Oli Corbion and I have been running a new survey of CEOs in the US for the last 3 years. And so we have some data there as well. And so what is striking here in this early years of high and relatively volatile inflation, the difference between these different types of agents is pretty small. But then you have this massive departure. Households consistently predict much higher inflation than professional forecasters of financial markets, right? So these guys, SPF, asset prices, they all predict inflation is going to be 2%. There is a relatively low variation. The small blips here are basically liquidity shocks. If you remove them, it's going to be extremely stable. You look at households, and it was not unusual to see inflation being expected at 6%, and there is a big decline, a big increase, a big decline. So there is low volatility. And on the top of this, the level on average is higher than the level of inflation expectations for professional forecasters and for financial markets. Now, for firms, it's kind of striking. When we launched this survey, the CEOs looked like households, then they started to look like professional forecasters, and now they look even more like households. Maybe they exceed the households in their inflation expectations. And so it tells us that it's important for us to understand not just what financial markets are thinking. They're probably the rational players. They have a lot of information. There's a lot of money at stake. And so there are huge returns to collecting and processing vast amounts of information, getting right these inflation numbers. But lots and lots of decisions are done on the ground by consumers and firms.
So Yuriy, can you tell us how far in advance? Is this 1 year in advance forecast or?
This is 1 year ahead forecast.
Okay. And the firms you survey, essentially these are the CFOs or the guys who really set the prices for the products?
So this is a survey of CEOs.
CEOs, okay.
CEOs, yeah. And you know, sometimes it's a manager and the founder. It depends who is available to answer questions. Mm-hmm. Probably some of these people are going to be CFOs. I would be shocked if CFOs have this high inflation expectations now. They probably rely more on professional forecasters and financial markets, but CEOs have, you know, many things on their plates, and probably they are less I wouldn't say affected, but maybe less interested in knowing SPF numbers than CFOs. So it's very clear there is a difference, and you know, there's different players have different expectations, and they probably act on these expectations. I'll show you some evidence to support this notion. And so then we need to understand how come households and to some extent firms deviate so much from SPF. You know, what is the reason or reasons that makes them believe inflation is consistently higher, or why it's so much varied over time. To this end, let me give you kind of an overview of what I'm going to say, and then elaborate on each of those points and hopefully convince you that this is not entirely crazy. The first thing which is going to be different between professional forecasters and households is going to be that they have very different interpretations of shocks. Okay, so they will have a very different interpretations of shocks. And to make this point further, they also have very different sources of information. As I said, I was very happy to see that most people in this audience rely on professional forecasters, but the general public is looking at highly salient prices. I learned now that in Germany it's chocolate, in the US it's the price of gasoline. It seems like everybody is really on the top of this price. But most people rely just on the price of gasoline, okay, in the US. In Ukraine, it will be somebody, you know, you look at the exchange rate, and this gives you sort of sufficient information about inflation expectations and the current inflation situation. And it's not a problem necessarily, but it makes a lot of sense if inflation is low and stable, you don't want to invest a lot of resources in collecting and processing information. You just need a quick and dirty way to get a sense, a measure of temperature in the economy, so to say. Those prices are very easy to observe. It's every corner in the US. You see the price of gasoline. In other countries, it may be exchange rate. I don't know, Markus, where you see the price of chocolate, probably in the store, but
yes, but the question is, how do you coordinate on certain products? Is this just the social convention? Have you ever looked at that? Or
it's a great question. I think ideally it should be a price of something very easy to observe, a homogeneous good, so you don't have to have questions about differences in quality. Like, you have a bunch of DVDs out there, but one DVD is valuable today, but then it's not valuable tomorrow. And gasoline, milk, I realized chocolate, maybe maybe it's one of those commodities that is very easy to observe and then say, okay, I can compare prices between today and yesterday and have a clearer sense of where prices are going. Now, what is striking is that these prices typically account for a very small fraction of goods actually purchased by households. And so those prices are going to play a disproportionate role in how people form expectations. Also, the low attention to monetary and fiscal policy in general. This is just to say that people have relatively little attention to shocks. Most of the shocks economists care about, like, what happens with the economy if the government spends another $1 trillion? What will happen if the Fed is going to raise the policy rate by 50 basis points? Most people don't care about this. I'll give you some evidence. And again, I was very pleased that this audience firmly believes that the inflation target of the Fed is 2%. At least their expectations are anchored. And I'm very happy to hear this. But you will see that people are very, very different. The general public has very different perceptions. Also, our models make very strong predictions about how people should respond to changes in inflation expectations. For example, the idea is if you have a depressed economy and you raise inflation expectations, that should stimulate the economy because people should, through intertemporal substitution, start spending more now, or they try to buy more durable goods while the prices for those durable goods are still low. In any case, this kind of policy, this kind of responses should help the economy to lift itself out of the recession. And you will see that in the data, these responses are much more nuanced. It's not that straightforward. Yes.
So have you looked at second round effects? So it might be, so you're saying they pay low attention to monetary and fiscal policy. So it matters why we have inflation. Well, that leads to second round effects or not. Or is it the case that they always want to then high wage compensation exposed and then we get the second round effect? So the underlying reason why we suddenly have high inflation, you suggest people don't take this into account. They say, okay, prices went up, we want to have higher inflation, higher wages, and then we get second round effects independently of what the underlying shock was.
Yes, Markus, it's a terrific question. The first round effects are relatively easy to answer with micro level data because you have a well-identified shock, you have the timing right, and you see for a specific person, is anything happening or not? And this is going to be one limitation of what I'm going to say, that we are not going to be able to see or measure second round effects. Now, having said that, I should say that we have a separate research when we look at higher order expectations and strategic complementarity in choices and beliefs. And there is something like this going on. So, my belief depends on what I'm thinking about what you are thinking, and you're going to do the same. And our decisions are going to be kind of moving in lockstep. But, if this is really important, if the strategic complementarity is so important, it also tells us that if nobody wants to raise prices, because I don't think my competitors are raising prices, or they're not going to change their beliefs that much, it also tells us that probably rigidities are going to be stronger. One unfortunate implication of that is, going back to your opening remarks, is if you change the focal point, then everybody can jump to a different equilibrium, and this may be a very bad outcome. This is why it's important to to keep inflation at 2%, not at 5%. Now, let me elaborate on each of these points. And as I said, hopefully convince you that people are different from professional forecasters and we should take it seriously. This figure here shows the dynamics of perceptions and inflation expectations for professional forecasters as the COVID crisis was unfolding. You start with inflation being expected at 2%, so their expectations are anchored. That's great. They also expected modest growth of GDP. But then as the COVID started to unfold, their expectations for output became much more pessimistic, right? So you go in this direction, you go down, okay? And at the same time, they revised their inflation expectations down, okay? So they saw that, probably it's a mixture of shocks, supply and demand, but the demand component probably dominated, and so they expected prices to fall. Now you look at households and you see a very different picture. First of all, you start with a higher level of inflation expectations, but that in itself is not that surprising given that given the figures I showed to you. What is most surprising is that these people start to move in this direction. Okay, so they believe the economy is contracting, right? So they think there is a problem, but they raise their inflation expectations. Here, inflation expectations for professional forecasters are falling. Here, households are raising their inflation expectations. And one way you can rationalize this is to say people have a stagflationary view of the world. They think inflation is associated with bad events, and not surprisingly, they're going to raise their inflation expectations if business conditions deteriorate. But having said this, I think this is not just about COVID. You can look at other episodes, other countries, and you will see a similar stagflationary view of the world for many, many households. For example, here, a picture for the US, just to have the benchmark. This is professional forecasters. You have this bin scatter plot where you take out time fixed effects, you look at the cross-sectional variation. And here, this theory is saying if you take a professional forecaster who predicts above average inflation, this person is also going to predict above average growth rate of output. Okay, so how we can think about this? Well, these people probably think that inflation is largely demand driven, and so it makes sense to have something like this. You look at households and you see a very different picture again. In the cross section, pick a person who predicts above average inflation. This person is going to predict below average growth rate of output. So it's very stagflationary here. Now, this is not just US. You can look at other advanced economies and you will see exactly the same picture. This is professional forecasters from Consensus Economics. Every country has this very clear upward relationship. More inflation, more output. So inflation is demand driven. You look at households, everything is downward sloping. This is telling us that inflation is perceived to be stagflationary. It's a bad event. The economy is contracting. So and you can get some traction if you use other surveys. Markus, yes, your question.
Can you look within households what education people have? Are they more educated, more like the professional forecasters? And does it matter whether I have a degree in economics or a degree in engineering? I don't know. I probably don't have this data, but it would be interesting to see whether.
Yes. So, in general, people with higher degrees of education have better inflation expectations in the sense they are closer to 2%. I'm not sure in the surveys we collect information about their degrees. It will be very unfortunate if people with economics degrees believe that something like this is happening. It will be a failure of education in the US and in other countries. I should also say that sometimes it's not just education. Michael Weber and co-authors, they have this wonderful paper about Finland where they use IQ scores of men in Finland from the military, I guess, sources. It's not related to Russia. It's just the regular procedure to measure IQ, make sure that the generals have high IQs. I guess. Anyway, so they find that people with high IQs have better inflation expectations and they have better relationships between macroeconomic variables. So they understand, for example, when inflation is high, it's a good time to borrow, while people with low IQ don't understand this. One thing I should say this, this is a cross section, but you can also follow people over time and see if their revisions and expectations, so within person, are going to be moving with revisions and expectations for output growth, and you'll find the same picture. That so even within the person, you will have something similar qualitatively.
So Ken Gris would like to know, you will talk about media and business media, I guess, later as well. Will you touch upon that? What's the role of media? You know,
yeah, so people listen to the media. Yeah, so people listen to the media. And one unfortunate thing about the media is that they tend to have very low, I shouldn't say very low, relatively low trust scores. So people get information from this, but they discount this information heavily. And one of the things which is really important for households is their personal shopping experience.
So it doesn't really matter whether I'm a New York Times reader or Wall Street Journal reader. There's
very little. Yeah, so we found that non-partisan newspapers, for example, USA Today, is more credible than New York Times or Wall Street Journal in the eyes of the population. But they find that, for example, social media are more credible as a source of information than conventional media outlets.
How do you measure credibility?
Well, you ask questions like, you know, can give us on the score from 1 to 10 the credibility of various sources.
I see.
So it's not
a little bit shocking in a sense.
It is shocking, but you know, it's probably a topic for another another lecture. So you see this stagflationary view of the world, and you wonder, you know, is this really stagflationary or something else is going on? And to answer these questions, you can look at other surveys where people provide additional information, and you see how this additional information correlates with what you see for inflation expectations and other measures of macroeconomic activity. This figure here comes from the Cleveland Fed. They have this wonderful daily survey when they ask people questions about inflation expectations. Is it a good time to buy goods? Is it a good time to buy medical supplies and food? Is it a good time to set aside money? This kind of things. And it was striking that at this daily frequency, you see the moment COVID hits the US, inflation expectations start to really increase, and people also have this much darker view of the economy. They don't want to spend. You see, this red line is going up. People say we should be saving, not spending. And what was striking was that not only this kind of phase, these variables are correlated, but what was striking is that when the COVID pandemic people saw was subsiding, the saving rate declined, so they said, okay, now it's a good time to spend again, and also the inflation expectations declined. So it's very clear from the micro level data that people believe that inflation is stagflationary. That is, it's a bad state of the world. It's not the good state of the world. And this is, I think, a warning.
Do you have data on this, on the 2007, 2008 global financial crisis? It was similar. The inflation expectations went up significantly from.
Yes, and people equally so. I mean, there it was clear that recession is happening. It's going to be bad. So maybe there it's less surprising that you have high inflation expectations and very bad perceptions of the economy. Here with COVID, it was a little less clear what is happening. Is it supply side or demand side?
I should interject something from Philip Hartmann, who says the ECB research shows that TV is particularly influential in Europe and social media less so. Perhaps there's probably, it also differs from country to country to some extent.
I would not be surprised. You know, this is, you know, people get their information from a variety of sources. In some countries, Facebook is, you know, a big deal. In other countries, there will be another social media. In some countries, you know, in Germany, for example, lots of people use cash, which is relatively unusual. And why they do this, I don't really know, but it may be one of those focal points when all people agree, let's watch, you know, TV and get information from that, or maybe let's talk to each other through social media and get information through that channel. Now, so this stagflationary view of the world, this is important because if inflation expectations are high now, okay, people have this very negative view of the economy. And you hear this in the media that we have a boom in the US, but people have a very gloomy economic outlook. They're very unhappy. And this will be one way how we can rationalize it. unemployment numbers are low. We see GDP grows at record rates, and somehow yet people are very unhappy. So inflation expectations could be one explanation. Sensitivity to salient prices. I would start by saying that it's impossible to prove anything beyond reasonable doubt in macroeconomics. We can't run an RCT or anything like this on a global scale or country level scale, and that's a good thing. Just to be clear, we don't want to experiment on countries. But sometimes observational evidence is so striking that it's hard to discount this and say, well, it's just a correlation. You kind of wonder if it's causal or if it's something very important there. And this figure here shows inflation expectations for households. This is the blue line, and the price of gasoline in the US. This is the black line. And what is striking here is that starting somewhere in 2000, year 2000, there is an astonishing correlation between the price of gasoline and inflation expectations, not just at low frequencies, but also high frequencies. For example, there was 1 month when the price of gasoline increased a lot. This was 1 month when inflation expectations shot up by, like 2 percentage points. Going back to your earlier question, Markus, Great Recession, huge increase in inflation expectations, huge increase in gasoline prices. Gasoline prices collapsed, inflation expectations collapsed. In 2014, when oil prices collapsed, gas prices fell a lot. There was a huge decrease in inflation expectations. So you kind of wonder, this has to be something real given this correlation.
So how big of the gasoline, how big in a consumption basket is it at the end?
According to the survey of consumer expenditures, it's about 5%. People spend roughly $2,000, which is a lot of money. So when the price of gasoline falls by 50%, it's as if you write a check to most households equal to $1,000. It's very significant. Now, if you look at more recent times, you see similar correlations. Prices of gasoline go down, inflation expectations go down. Price of gasoline increases, inflation expectations increase. And during the COVID crisis, it's the same story. Inflation expectations, the blue line, the black line is the price of gasoline. They're moving very strongly. And now we have really high prices of gasoline in the US. Again, I was very happy to see that most people are aware of that. Because, when you often want to shade politician, you ask them, what's the price of milk or, some particular item that many people buy, and they usually have no idea what is going on. And that will be a sign that these people are detached from reality. It is very clear that economists in this audience are not detached from reality. They know the price of gasoline. You pass that test. But what is striking here also is that SPF, the professional forecasters, don't really have the sensitivity because they look at many more prices in the economy. They have a lot more information. They probably have a better sense of shocks hitting the economy. So it makes perfect sense that there is some difference, but what is striking is that this difference is so big now. Professional forecasters say inflation is going to be basically 2%. Household CEOs say it's 5% or higher.
So, but can I suggest something a little bit bold? Would you use the strategic reserves in the United States in order to control inflation expectations and hence positively impact, monetary policy? I mean, it's a little bit of a crazy thought, but we have strategic reserves. If gasoline prices go out of hand, and there might be second round effects on inflation expectations, and we can use the strategic oil reserves essentially to.
Markus, I would say it's not entirely crazy. And to my great surprise, there was a discussion in Congress about reducing gasoline taxes temporarily. The federal gasoline tax is about 20 cents per gallon. There is also a tax at the state level, so you can play it with those numbers and you can reduce the price of gasoline so that, maybe the Fed can buy a network of gas stations and sell cheap gas. That will be another solution. But in other countries, it doesn't have to be gas. Like, if you're a small open economy, your exchange rate is the most important price and very salient, very visible. And so their monetary policy can have much more control. And to some extent, the Fed is also controlling this. If the dollar appreciates, it will make the dollar, it will kind of indirectly reduce the price of oil. as it's determined in the global markets.
But would you also go so far? Let's suppose we impose price controls. Nobody is arguing for that, I guess, seriously. But you would target then gasoline price controls because it has bigger impact than price controls in some other aspects. Or is this?
Yes, that would be another way to control prices. But obviously the challenge is that if you do this, it's so convenient, it will be so popular, it will be impossible to remove, and so it's going to hurt us later. It will help us now, but hurt us later. So I hope I convinced you that the price of gasoline is a strong predictor of inflation expectations in the US. I understand other prices, maybe salient prices, maybe other strong predictors of inflation expectations, maybe determinants of inflation expectations. But again, the key contrast here is that professional forecasters have a very different view of how this works, and we should appreciate this difference. Low attention to monetary and fiscal policy. All right, so this is my favorite part because I realized from the survey everybody believes 2% is the inflation target of the Fed, but I'm very grateful to two people who said that the inflation target of the Fed is 5%. You are more like normal people. You think inflation is much higher, and the Fed is targeting a higher rate of inflation. We ran a survey of the CEOs before the COVID crisis, and we asked these managers to tell us what they think inflation target of the Fed is. And to our great surprise, only 25% of people gave us a number between 1.5 and 2.5. Okay, the range which is most relevant probably for the US economy. Then we have lots of people who are kind of too low or a little too high, but most of all, we have people who explicitly said, I don't know, a third. And then 20% gave an answer which was basically incomprehensible. And we take it as an answer we don't know. So roughly 50% of people explicitly said we don't know, and only a relatively small fraction of people had the right inflation target. Now, for households, it's even more extreme. You have lots and lots of people who basically say inflation is 10% or above, or they explicitly say we don't know. And in itself, this is not a problem. Maybe it's a sign of success. Keynes famously said that I want to make economic policy as boring as dentistry. And you go to a dentist, you don't need to know what he or she does to you exactly. You just know it's going to be okay, and you trust that person. Maybe we're at this stage. We have years of stable and low inflation, and maybe not surprisingly, we have this wall of inattention to monetary policy. It also gives us some challenges, because if you want to communicate with the public to move their expectations, it's very hard because they don't know who is talking, what they're trying to communicate. I'm sure many people wouldn't know who's Jay Powell or Christine Lagarde. So, when you see them on TV or in social media, you wouldn't know why you need to listen to them. So that's going to be a challenge. But on the other hand, it creates this space for maneuver that, the Fed, the ECB, they can do some aggressive policy to help the economy or, help financial markets without igniting inflation expectations, simply because people don't pay attention. Okay. Eventually, obviously, they will start paying attention, but in the short run, they don't have to.
So there's a question from Laura Allen. She would like to know whether there's a lot of hidden information. So people feel there's a lot of hidden information, so the official numbers are not so relevant anyway for their own consumption. Did you ask anything along that line?
Well, we didn't ask them about conspiracy theories and is the government taken by somebody and there is a secret chamber which produces fake numbers. But I would say this, we ask people to tell us the weights for different groups of goods that they use to calculate their perceived inflation numbers. So, for example, we know the price of gasoline. Gasoline accounts roughly for 5% of the consumption basket for a typical household. So we can ask this person, how much inflation is accounted by changes in the price of gasoline. And the typical response would be something like 20%, 25%. Yeah, so much, much higher. people also include asset prices as something that goes into their notion of CPI. The price of a new house, the stock market, they all say it's it's there. And so to some extent, we have inflation in all of these variables. Stock market is booming, asset prices are super high, but people don't understand that it's not the purchase of a new house, it's the rent that counts. And so it creates this disconnect, and people have consistently much higher inflation expectations than professional forecasters. All right. Now, one thing which is very cool with the survey is that you can do this in real time, and you can see if people actually responding to policy actions. And you see how much reaction you can get from some policy announcement. There was this famous talk by Chairman Powell at the Jackson Hole when he announced average inflation targeting. And he is a great communicator. I really admire him. He laid out it in very simple language, saying, this is what it means for you in terms of inflation. And I guess, like many people in this audience, I was watching his talk very, very careful and taking notes. Okay, this is what is going to happen. I should have a variable rate mortgage or maybe a fixed rate mortgage. But then you can, in real time, ask people questions. Have you heard this announcement? Did you understand this announcement? If we explain to you the difference between average inflation targeting and conventional inflation targeting, would you, get it and maybe change your behavior? And we find from the surveys that people didn't hear about this announcement. They didn't understand what Powell was talking about. And even if you give them a little bit of information, nudge them into kind of understanding what this means, they still fail to fully grasp the implications of this new policy regime. Now, this was done at relatively high frequencies, like immediately after his talk, just before his talk. But even 1 year later, when we do the surveys, people still don't know we have this new policy regime, and they fail to realize what this means for inflation.
Did you also ask mortgage brokers who really tell the households or mortgage?
No, Markus, unfortunately, it's relatively easy to construct surveys of households. They're relatively cheap. Reaching out to CEOs is extremely difficult because you have to penetrate through layers of secretaries, assistants, so many filters. It takes forever to talk to somebody. The same with mortgage brokers or financial intermediaries like, bond traders. But I hope there will be some survey where people can elicit beliefs from these important players and see if they think differently. I'm sure about the bond traders and mortgage brokers know all about this.
So Giorgio Brunnermeier would like to know, is it possible that people with inflation expectations that are off are the same people who don't really make important economic decisions because they're hand-to-mouth agents, let's say, in our models?
Yes, it's certainly a possibility. Inflation expectations, we know through the Euler equation, matter only to the extent you can intertemporally substitute, right? And so if you have no resources, then it doesn't matter. And one may hope that there is this magical marginal consumer who is making the right decisions. And maybe there is something like this out there. But, if you have 80, 90% of the population who doesn't do this, I don't think it's a good sign for our models.
Are you building new models with people where they don't have correct expectations? Or how would you build new models if you were a theorist?
I think one lesson I learned from looking at the history of thought here was that in the 50s and 60s, there was this view that people know nothing. It was kind of a focal point of those models at the time. When they swing to another extreme, people know everything. And we try to find this middle ground. And the problem is, if you have something in the middle, we will have very little discipline. So I'm still trying to find the balance between being flexible and having some discipline on these models. But I'm sure if not me, somebody else is going to come up with a successful model. So Jay Powell, it was striking. This one of the biggest announcements out there in recent history about monetary policy. No reaction. It was amazing. Now, as I told you, the last point was what happens with choices, right? So as you know, the earlier question, maybe we have these expectations, but it doesn't matter because people don't usually use them for anything important anyways. They don't act on these expectations. And some people may believe the earth is flat, and locally it's a good approximation. It doesn't really matter for this person in the big scheme of things. Maybe it's the same deal with inflation expectations. Like, it's not important. And as I said in our previous exchange, the main challenge is that if you want to see the effect of inflation expectations on, say, consumer spending, you have to obviously worry about endogeneity, that so many things are happening at the same time. How much you consume depends on what you think is going to happen to you tomorrow, in a month, in a year. Not just inflation expectations, but many other variables. And so creating an exogenous variation here in inflation expectations is a huge challenge. And this is one of the reasons why we have, which paper about the importance of inflation expectations, saying that it's not terribly important, but just, an object floating around in our models with no real bite. And I can understand how we can be frustrated with inflation expectations, or in general expectations being so endogenous and so hard to measure. How we can address this? It's a huge challenge where we have to rely on natural experiments, changes, for example, in tax rates on gasoline, and say, well, here is an exogenous change in the price of gasoline. Let's see if it's going to change the expectations. I have a project where we look at disruptions of oil refineries when the price of gasoline locally can increase for largely idiosyncratic reasons, and see if people change their expectations, if they change their consumption decisions. But if you take this route, you're at mercy of these strange events, and you can't replicate this in other contexts, in other countries, in other times. And so it kind of limits the usefulness of this exercise. But if you can run a randomized controlled trial, then you can do this anytime, anywhere, and repeat these experiments again and again and again, and have some confidence that you will find something meaningful. Now, I never thought that I will run experiments in my life. I was trained as a macroeconomist, so you know how to run a VER, how to write a DSG, how to solve it. I was never taught how to run an experiment, but I'm grateful to my colleagues in Berkeley that they gave me some pointers what I should do, and that was very instrumental for me. And so just to keep everybody on the same page, I wanted to outline a few steps here to make sure we understand what is happening with this RCTs. The first stage is preliminary. Say you have 10,000 people, you ask them what inflation expectations you have. Then you flip a coin and create two groups, randomly chosen, a treatment group and a control group. The control group is told nothing. The treatment group is told something about inflation or inflation target, some policy action, or some actual fact about the data. You can lie to people, but you can tell them, a selected set of facts. Then you measure the expectations again. And if you see any systematic difference between these two groups, it has to come from the treatment, because those two groups otherwise are identical, right? They have the same distribution of age, education, IQ, everything is the same. The only difference is this treatment. And then you follow these people over time and see if they change their behavior, if they change their consumption, if they change their employment, if they change their portfolio allocations. You can look at lots and lots of choices that people make in their lives. Now, tracking people is expensive, right? So this is not an easy exercise. But if you're a central bank, if you're some government body, a big research institute, this is a rounding error in your budget. You can still do this. And so then when you compare the choices of households or CEOs or anybody else you're interested in, if you see any difference in consumption, it has to come from this treatment. And through this channel, when you measure the expectations, on impact how they change their beliefs. And so that was the main channel of this treatment effect. And let me show you, what you can find in this experiment. So I'll give you one example, but you will find something similar in other contexts as well. You can tell people anything you want in terms of treatments. You can tell them about the Fed inflation target. You can tell them about the inflation forecast from professional forecasters, from your peers, from professional forecasters and your peers. You can do lots and lots of things. You can also tell people about forward guidance. You can tell them, well, the Fed promised that the interest rate is going to be such and such in 2 years or such and such in 3 years, and see if people react to that information. It doesn't have to be about monetary policy. You can also do fiscal policy.
Did you also do, like Gene Farmer want to know, QE, is it different by
You
telling
can
them
do
about
QE
QE?
too. You can do QE too. They'll ask you, what is QE? Yeah, so, you know, one challenge when you do these experiments, when you do these treatments, you have to provide information in a way that is understandable for the general public. So you can't use jargon. You have to explain what CPI is, what inflation is, what deflation is. So I should say, when you do these treatments and you see some reactions in the beliefs of those people, it's already a violation of full information rational expectations. We give them publicly available information. You can go to any website and find inflation numbers. So you can Google the inflation target of the Fed. You know, they keep talking about this all the time. So it has been in the public domain for so many years. Everybody should know these numbers. And yet we'll find that beliefs respond very strongly to these treatments. Okay, so for us, it's already suggesting that there is a violation of this full information rational expectations. Now, so let me go back to this equation and say, you know, what happens if we treat people with forward information or with inflation? I'll show you results for the case when we tell people the actual inflation number. So, for example, you tell me, well, you know, inflation forecast is 5%. Will tell you, oh, your perception of inflation is 5%, and we'll tell you, no, the actual number is 2%. And we see how you change your beliefs. This is going to create this exogenous variation, and then we track you over time and see if you change your consumption. This is what you find for purchases of food, and this is in the Nielsen survey. So this is not just survey answers. You have a home scan, and so we know actual purchases of these households. You can also use a survey to measure this data, and you'll see a high consistency there as well. But this is telling us that if you exogenously increase inflation expectations, people, at least in the short run, buy more food. Okay, so this is to some extent consistent with the Euler equation we usually have when we think about the effects of inflation expectations. But
how should I interpret the size of the coefficient? Can you interpret the size?
Yeah, it is very large. So you raise inflation expectations by 1 percentage points, and people buy half percentage, spend more on food per half percentage. So it is a lot. And you look at other types of goods, and their response may be even bigger. So in any case, it's significant, not just statistically, but economically. And on the other hand, you look at purchases of durable goods. You ask people, did you buy a car? Did you buy a house? Did you buy an expensive appliance? And here, it's very clear you raise inflation expectations and the frequency of those purchases declines by a lot. Okay, so people are less willing to buy cars. They are less willing to buy houses. And one way you can rationalize this is the stagflationary view of the world, that, you know, you change not just beliefs about inflation, you change beliefs about other variables. And through this reduced form relationship, then it translates into lower consumer spending. But in our models, typically this channel that, you know, you change beliefs about inflation expectations and about other variables would still mean that you should spend more on durable goods. It's a good time to buy a car. The prices are still low. Your income will be high in the future. You should be buying cars. You should be buying houses. It's not true in the data. And so one big policy implication is that if you have this idea that you can raise inflation expectations and everybody is going to be happy and start spending, maybe it's not such a great idea. This kind of policy can backfire, and we see this now when inflation expectations running so high, and actual inflation being so high. People have this dark view of the world, and it seems some withdrawal from consumer spending can happen.
So even though you would expect the opposite, especially if the interest rate stays low.
Yeah, yeah.
So
Well,
there are some questions. So in the audience, perhaps I can throw this in. There, especially on durable goods, they would like to know more. And does it matter how you finance yourself? So you go into a mortgage or you go into some funding? Did you look at the? And then another question about the randomization. Jorge Janlao was actually concerned. Is it really fully randomized if you tell one group that I get this information? Did you tell the other group which didn't get the information that, you know, could have gotten information, but we didn't give it to you? It's like a placebo. You tell them is a placebo or not. So how do you deal with this placebo pill in
so with placebo,
research?
you know, the way I describe this, you flip one coin and you create just 2 groups. But in practice, you can create 100 groups or 10 groups. And when we do this experiment, one of the placebo groups would be, we tell people something which is irrelevant but has 2% in it. So they can say, you know, the speed of Earth increased by 2%, or the population growth rate is 2% over some number of years.
I see. Okay.
And so we see if people respond to 2% in some way. And there is some reaction to this. It's called the anchoring effect, but it's small, it's short-lived. If you tell people about inflation, you see much stronger reactions.
And Andrei Alexandrov has an interesting question. Do you look what people's expectations about their wage growth? Did you look at wage growth expectations as well?
Markus, it's a great question. And, you know, very often we go back and kick ourselves and say, we wish we had that question. With this experiments, you do it, you get your results, and then later you realize you missed something and you have to redo everything. And so we are now doing a survey when we ask people about wages and inflation expectations at the same time. And I know there are other teams out there doing this experiments. So, you know, in a few months, we'll probably have an answer, or maybe in a few weeks, who knows. But that's a great question, because then you can directly look at price wage spirals, you know, how they happen, are they happening? It will be also related to your earlier question about second order effects, second round effects. So I was talking a lot about households, where firms are, you know, they're somewhere in between. I don't have time to cover this in great detail, but the general idea is that these guys somewhere between households and professional forecasters. They're not as informed as professional forecasters, but they are not as uninformed as households, somewhere in between. Again, using randomized controlled trials, we know when you provide these managers with useful information about inflation targets or prices or anything that may help them in their decision making, we see that managers respond to this information. They change employment, they change investment, they change the composition of their employment, they change prices. So it is very clear that people act on expectations. We have to, if we want to affect the economies or expectations, it's going to be challenging because people don't listen, but conditional on making this connection, reaching out, then you can actually do something good for the economy, at least in principle. And in my remaining time, I'll just very briefly say, you know, where we are. And Markus, you should tell me if I answered your questions, and maybe some of them.
No, I have a few more questions. Perhaps I'll save it to the end.
Okay.
But I would like to get your lessons for macroeconomists.
All right. So, you know, look, we have this great framework in macro, full information, rational expectations. It's a major achievement, and we should all be grateful for people who develop this. But I think at the same time, you look at the survey level evidence and you see that the world is not that simple, right? So Yogi Berra, a famous baseball player, said, if the world were perfect, it wouldn't be. Right, so it's too good to be true to have a perfect world. I agree with him. It would be nice to have fire, but I don't think it's true. We need to find some alternatives, some compromises. I don't think we necessarily have to abandon rationality, but, you know, some information rigidity, some cost, maybe a good way forward. So then you can kind of keep all people happy. I think one challenge here in terms of future work, and this goes back to your earlier question, Markus, where we are in terms of modeling. I think one issue here is that we have theory ahead of measurement. We have so many theories of how people can form expectations, but we don't really test them that well. And I think a lot of work that we need to do is about, doing this rounds, this iterations between theory and empirical work to make sure that, we have a model which is consistent with the data. There is some discipline from the data, and we keep iterating until we have some convergence. We also need more surveys, more RCTs, because I think this is the only way to prove anything beyond reasonable doubt and convince people who wrote, which paper that inflation expectations are important, or in general expectations are important. And the very last slide is about lessons for policy. I think it's very striking that policymakers talk about inflation expectations all the time, and yet the public is relatively unaware of what is happening in the policy world. There is massive inattention. People have very limited span of attention. You should really communicate in tweets, like 144 characters or maybe a little more. This is how it should be done, I guess. We should also appreciate that there are lots and lots of frictions. People are inattentive for a reason. Sometimes it's just lack of education. Sometimes it's IQ. Sometimes it just doesn't pay me to pay attention to anything because inflation is not a big deal for me anyways. How much difference for a typical person 1.9% inflation make relative to 2.1% inflation? Very little. So it's not the biggest factor for them. I see a lot of heterogeneity in beliefs, and we should understand there are lots and lots of possibilities for misinterpretation. When you say raise inflation expectations, people may say you're doing something crazy. You should not be doing this. We don't want to have more inflation. And so in terms of communication, I think this research suggests that you have to have simple and direct messages. You have to give a perspective. You have to say, look, we're doing this for X, Y, Z reason or reasons, and kind of focus on maybe on targets instead of instruments. There's a lot of talk about we're going to do this or that with Fed funds rate or this or that policy rate. But we should be clear with the general public what we want to achieve. And they probably don't care what you do. They won't care if it's QE or changes in Fed funds rate or quantitative tightening. They don't do this. And we need more measurement for sure. And we need, I think if we want to really influence the public opinion, we have to have sustained information campaigns because people forget these messages very quickly. So I'll stop here.
Thanks a lot, Yuriy. So we have a number of questions I would like to touch upon. Sorry, I can't cover all of them. Mm-hmm. One is, so we have all this research from Ulrike Malmendier and Stefan Nagel on depression babies, and also they have a paper on the people who lived through the 70s have different inflation expectations. Do you think that we lived through the global financial crisis with very low inflation has impact on and people who lived through it and people who didn't live through it? So can we distinguish that? Can you elaborate on that? And you also highlight very much the gasoline price matters a lot, but it could also be that focusing on attention, what you mentioned on that slide, that the used car price jumped significantly, is totally in the news all the time, and probably most people pick that up. Is there some other products which are just moving very radically? Does it make a difference whether everything moves in the same pace and nothing stands out and people ignore it, and suddenly you have one product which jumps a lot and that essentially shifts all inflation expectations across all the products? I mean, it's highly speculative, but perhaps you have some insights on that too.
Markus, I must say, I really believe in this lifetime experiences shaping expectations. I lived in Ukraine for many years. I lived through hyperinflation, 10,000% in 1 year. I'm always worried about inflation. I know it can happen. Probably it will not happen in my lifetime again. But, it has happened. And so I'm always worried that, something bad can happen. Why people focus on some prices, particular prices. I don't know why we create this, where those focal points come from. It's easy to imagine that, in some countries, it may be the price of copper, right? So you look at Chile, it's a big, industry, and people are watching that particular price. And so you can have a story about that. presumably it has to be something related to fundamentals, otherwise you're wasting your time. And I think for US households, it's, if you have limited span of attention, it makes total sense for you to look at the prices of gasoline. We know historically it's highly correlated with inflation. It's extremely easy to observe. It's a homogeneous good. You do these purchases very frequently, so you can have basically a real-time estimate inflation from the prices of gasoline. Can you move that focal point? I don't know. It's hard to tell. I wish I could do it.
So that leads me to the final two questions. Perhaps I do one at a time. One is, we're going now through a green restructuring of the whole economy, and that will, of course, mean that one thing, we move away from cars which use gasoline, we move to electricity. Mm-hmm. So do you think where will the focal point jump if everybody has an electric car now? Will we stick with gas prices as our focal point or not?
I wish we had all electric cars. We use public transport. And, there is something to this. You compare inflation expectations of Europeans and Americans, and Europeans are much less sensitive to the price of gasoline. They're still sensitive, but not as much as people in the US. And one story is that in Europe, people rely on other means of transportation, public transportation in particular. And, once you create this disconnect, then the fluctuations in commodity prices are going to be less important for you when you think about inflation expectations and inflation.
Let me throw a final question at you, which comes from Hasley Rogers. He would like to know, can you compare, the US and an emerging economy? So we touched a little bit upon this, but he thinks of Argentina. Is the gap between households and professional forecasters smaller in emerging economies because it's just way more at the forefront of people's thinking? Or in US, you can forget about it. I call it worry-free inflation because it's roughly 2%. But if it's jumping a lot, it has to be at the forefront of your mind and affects your
absolutely, absolutely. There is a lot of, as I said, I'm from Ukraine, and when inflation was high, you wake up in the morning, you read your inflation numbers, you go to bed, and you read your inflation numbers during the hyperinflation. Mm-hmm. You know the names of the central bankers; they're like rock stars. You try to hear every word they say. You talk with your neighbors, with your friends about what this means for prices going forward. And so this inattention, it's really state dependent. We have a luxury in advanced countries that we didn't have inflation high and variable for so many years that for most people, it's not just an important subject. It doesn't really matter. While you'll go to emerging economies, Argentina, Ukraine, Mexico, where you had bouts of inflation, or memories of this are still very recent, people are really much more attentive to inflation, and they don't rely just on one price. They have a much broader view of what is happening with prices in the economy.
And finally, just a side comment. Some people argue, high inflation, because economists think high inflation means high demand and means high GDP growth. For many people, inflation is a sign about the quality of the government, or how well is the country run. And I guess for the households, it's much more high inflation is a sign of weakness, not of a bustling economy. And that might explain why what you have shown us, that the professional forecasters are so different in terms of and households compared to the
It's certainly possible because, you look at high inflation numbers and it tells you can't control this, it's a problem. And so there is something wrong with the leadership. It's possible.
Very good, very insightful. Thanks a lot, Yuriy. It's great to see your perspective and all your research put nicely together here and give us the insights, what drives really inflation expectations and what more has to be done. And I hope everything is going okay in your home country. And
thank you.
Our thoughts will be with Ukraine in the coming months.
Thank you, Markus. Thank you.
Thank you. Thanks again. And next week, we will have Arvind Krishnamurthy talking about the lessons from QE we have learned for the last X years about QE. Hope to see you again. And thanks. Bye-bye, Yuriy.
Thank you.